In 1989, Japan looked invincible. Its stock market was the largest on earth. Its banks were the most powerful. Its companies were buying icons of American capitalism. Economists openly asked if Japan would dominate the global economy for the next century. Then something unheard of happened. The money vanished, prices stopped rising, growth slowed, and never truly came back. What was supposed to be a short recession became a decade of stagnation, then 2 decades. This is the story of how the most disciplined, technologically advanced economy of the 20th century fell into one of the longest economic standstills in modern history. Japan's rise begins in total destruction. In 1945, the country was economically shattered. Cities were burned. Factories were destroyed. Industrial output collapsed by more than 90%. Inflation spiraled. Food shortages were severe. The yen was nearly worthless, but Japan rebuilt with a unique model. Damrent, banks, and corporations operated as a coordinated system. Instead of free market competition alone, Japan used strategic planning. The Ministry of International Trade and Industry guided capital toward industries that mattered: steel, shipbuilding, automobiles, electronics, and machinery. Banks provided long-term low-interest loans. Corporations focused on market share, not short-term profits. Workers stayed with the same company for life, reinforcing stability and loyalty. By the 1960s and 1970s, the results were historic. Japan's GDP grew at rates exceeding 10% annually. Exports surged. Productivity skyrocketed. By the early 1980s, Japan was no longer rebuilding. It was competing and winning. The turning point came in the mid-1980s. Japan had become an export powerhouse, especially to the United States. This created massive trade surpluses and political pressure. In 1985, the Plaza Accord was signed. Major economies agreed to weaken the US dollar. As a result, the Japanese yen strengthened rapidly. A stronger yen made Japanese exports more expensive. To offset this, the Bank of Japan lowered interest rates aggressively. Money became cheap. Very cheap. Banks expanded lending at unprecedented speed. Credit flowed not only into factories and innovation, but into assets. Real estate prices began to rise. Stocks followed. Land in Japan had a cultural and economic status unlike anywhere else. It was viewed as scarce, permanent, and incapable of losing value. As prices climbed, land was used as collateral for more loans. More loans pushed prices higher. The feedback loop accelerated. By the late 1980s, asset inflation dominated the economy. Tokyo real estate prices tripled in a decade. Commercial land values in prime districts rose even faster. At the peak, the land beneath the Imperial Palace was estimated to be worth more than all the real estate in California. The Nikkei 225 stock index surged to nearly 39,000. Valuations were extreme. Many companies traded at price-to-earnings ratios above 60 or even 80, but profits were no longer the focus. Rising asset prices were. Corporations borrowed to speculate. Banks competed to lend. Regulators hesitated to intervene. Japan's success created overconfidence. The belief spread that Japan had invented a superior economic system, one immune to collapse. By 1989, inflation fears began to rise. The Bank of Japan faced a dilemma. Asset prices were exploding. Debt levels were rising rapidly. Speculation was widespread, so the central bank changed direction. Interest rates were increased. Credit conditions tightened. This decision marked the beginning of the end. Speculation slowed. Buyers disappeared. Prices stopped climbing. And then markets built on perpetual growth. Stagnation is enough to cause collapse. The stock market fell first. In December 1989, the Nikkei peaked near 39,000. By 1992, it had lost more than half its value. Billions in paper wealth evaporated. Confidence collapsed. Real estate followed, with a delay. Land prices declined slowly at first, then relentlessly. Year after year, values fell. Collateral vanished. Loans turned toxic. Banks were trapped. If they acknowledged losses, they would become insolvent. So, they delayed. Bad loans were hidden. Struggling companies were refinanced instead of restructured. Zombie firms survived without productivity or growth. The financial system froze. Like inflation, deflation is subtle. Prices fall. Consumers wait. Investment slows. In Japan, deflation took hold in the early 1990s. As prices declined, debt became heavier. Companies delayed expansion. Households saved instead of spending. Economic momentum disappeared. Even as interest rates approached zero, borrowing did not recover. Confidence was broken. The economy entered a cycle that fed on itself. Low growth, falling prices, weak demand. The 1990s were labeled the lost decade, but stagnation extended well into the 2000s. GDP growth averaged less than 1%. Wages stagnated. Job security weakened. The government responded with massive stimulus. Infrastructure spending surged. Public debt exploded. Japan avoided mass unemployment and social collapse, but it paid a long-term price. Innovation slowed. Staking declined. Economic dynamism faded. Not everyone suffered equally. Large exporters survived by expanding abroad. Global brands adapted, but banks were crippled for years. Construction firms collapsed. Small businesses disappeared. Young workers faced limited opportunities. An entire generation entered a stagnant economy with declining expectations. Japan's experience changed global economic thinking. It proved that asset bubbles can paralyze economies for decades. It showed that delaying losses makes crises worse. It revealed how deflation can be more dangerous than inflation. Central banks around the world studied Japan carefully, especially after later crises in the United States and Europe. Japan's miracle did not end in chaos. It ended in silence. No crash of civilization. No mass unemployment. Just a slow erosion of momentum. The lost decade stands as a reminder that prosperity built on rising prices is fragile. When debt replaces productivity and speculation replaces growth, even the strongest economy can stall. Markets always correct. The only question is how long the consequences last.